Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the show and to the Equity Mates community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Always am excited. There's so much happening at the moment. It's hard to keep up. We are seeing the Australian election in full swing, the housing pump on display.
Big time, big time.
We're seeing a slight breath in the US markets as Trump ponders his next move, or his focus gets deviated to universities and other things.
Yeah.
But all the while, the thing that reassures us, the thing that it does get us excited is that companies continue innovating, continue working on new technologies, new ways of doing business, opening up new markets, all to make their shareholders more money. Beneath all the noise, that is what matters over the long term. That is what really gets us excited. That's what we're going to talk about today, amongst all of the noise as well.
News and markets.
Well, Ren, let's get straight into it. I mean, we can't start a news segment without an update on where tariffs are at, because that's absolutely driving markets at the moment. Everyone's on edge, going to bed each night, wondering what Trump's going to tweet when we wake up, checking Wall Street Journal, New York Times first thing in the morning. But it has been a bit of a calmer week than last, that's for sure.
And we should say the best place to check in the morning is the Equity Mates Daily newsletter.
Yeah, we do the checking for you.
Yeah. Literally, that last week, we were setting our alarms for 5, waking up and then rewriting what we'd scheduled the night before because so much had changed. That's the dedication we have to this newsletter. That's why you should sign up.
Yeah.
The link is in the YouTube description or the podcast show notes.
That's right.
But what do we need to know this week?
The main thing is that the US-China trade war keeps escalating.
Yes.
So at the time of recording, because of course could change any minute, China have 125% tariffs on US goods, and USA have 145% tariff on Chinese goods.
Yes. China are also doing non-tariff measures.
Yes.
So are the US, to be honest. You know, they've restricted the supply of advanced semiconductors for years and stuff like that. But China has a particular dominance in rare earth minerals.
Yeah.
And I think they have 70% of the world's production, 90% of the world's processing, thereabouts. And they are starting to put export controls on that.
So will Trump go, we'll release we'll drop all tariffs if we can own your rare earth minerals?
Well, it's hard. Because the problem with rare earths is they're not rare. No. They're incredibly ubiquitous, but they're incredibly low value to extract, but also incredibly environmentally damaging to extract or to process. So it's not like America is going to want to spin up its own rare earth industry. Anyway, the ABC podcast, if you're listening, they did a good episode on rare earths, worth watching to understand. But yeah, so China's going to start flexing its muscle. But I've noticed something about how China is flexing its muscle that I want to bring to you. Because as you know, I spend a fair bit of time on TikTok, particularly for our TikTok investors segment that we sometimes do on the podcast, that we also do every Friday on our Instagram. I've noticed 2 big trends emerging.
Okay.
The first one is a massive increase in content from Chinese factories.
Okay.
Which is something I've never seen before, but has really started in the last week.
As in like a day in the life of, or like a behind the
scenes? More like, here's this Lululemon sportswear. We're the factory that makes it. Here's all the secrets you need to know. Here's how much it costs. Contact us if you want to just get them made directly.
Really?
Yeah.
Direct outreach, direct sales.
Well,
direct.
And the story is that China it's a rumor. Yeah. China has lifted its secrecy clauses on luxury goods manufacturers as part of this whole trade war. I'll play you one.
So China was the one pushing that on them. I thought that would have just been the manufacturer.
Well, yeah, but maybe China is pushing them now to, share this stuff.
Yeah.
I'll give you an example.
Do you recognize this style, this bag? Of course you do. For the past more than 30 years, we have been the OEM factory for most of the luxury brands around the world. Gucci, Prada, Coach, Louis Vuitton, you name it. But for this, I am not proud because we were only making our wages. The profit margin for the people who are actually making the bags are very low. What I'm really proud of is that first, we have the best quality control. Two, we have the best craftsmanship. Chinese craftsmen are always intelligent and diligent. Three, we have the most complete supply chain. We always get what we want, like zippers, accessories of any kind, any color, and leathers immediately. Now, as the USA and its little European brothers are trying to refuse Chinese goods, don't you think luxury brands are not trying to move their OEM out of China? Yes, they did, but they failed because the OEM factories out of China, they don't have good quality control and they don't have as good craftsmanship. Their workers are either too expensive or too lazy. Three, they don't have any supply chain. They always have trouble getting leather or zippers or any accessories. That is why they failed, and that is why we will always be the best OEM factory for luxury brands. Why don't you just contact us and buy from us? You won't believe the prices we give you.
Wow.
Yeah. So a lot of them finish with contact us.
Yeah.
And there was one that I
Did he
saw.
leave his details?
No, well, there's a bunch where they share specific websites to go to rather than Alibaba go to like these, factory websites. So that's one trend that I've noticed on TikTok, things that I've never seen before, but I'm just everywhere now. And now you're seeing them get like sort of resurfaced on Twitter and the like, because people are like, what's going on here? So it's not just that my algorithms changed. But then here's the other thing that I've started noticing come up on my TikTok feed. So that was pretty punchy, but then like really punchy anti-Trump Chinese influencers. And so I've pulled one from my phone to show you.
Chinese influencers.
Yeah. So this one, I just watched this on my phone.
Hello from China. Let me show you the United States products in my home. Nothing. Do you have something from China in your home?
Just stuff like that.
Wow.
Yeah. So look, is that what will that
What do you
do?
read in? How do you read into that? It's like, is this being driven by Chinese government?
I would say this is a
Soft.
Yeah, it's like this is the way that they can influence people's opinions on the trade war.
Yeah.
Is get the fact that China has all this manufacturing and
crucial supply chain.
Yeah. So I think, the takeaway here is that Ren spends too much time on TikTok. One,
yes, that's true.
But two, that China is up for the fight and they're pulling all the levers that they've got.
It's fascinating. I think on top of all of that, we're seeing a continuation of Trump whiplashing all over the shop. So we said there that there's sort of but huge tariffs from either side. But we're now starting to see specific, products be exempt from some of these tariffs. So the most recent is a lift on tariffs on all computers and phones.
Yeah, confirming my view that Tim Cook is the world's most effective diplomat.
Well, I mean, he's done an incredible job. We spoke last time about the fact that if this was to really push through, Apple was up to about $40 billion in cost to its bottom line. So he's done an incredible job.
Yeah, I mean, but even before that, think about what they've done. His key manufacturer is Foxconn, a Taiwanese company that then is massive in China, so managed that relationship, but also then built a massive supply chain out of China into the US, managed all through the first Trump term to balance that relationship, and now into the second term, potentially still doing that. He's so effective.
Yeah.
But
what you can do when you're one of the biggest companies in the world.
But Trump then posted on Truth Social that electronics weren't going to be exempt, and that we need to make those products in the United States, calling China a hostile trading nation there again. But we're still sort of watching and waiting to see where electronics ends up. I mean, speaking of Trump whiplash, this week Trump also said he was going to try and help automakers after putting the 25% tariff on automakers. So it's again just unclear.
Super unclear.
Yeah.
So look, plenty going on in the space. I think if you just take a breath and think about the craziness of the last sort of couple of weeks, if you look at actually where markets sit over the last month, the S&P is now only down just over 4% and the NASDAQ down just over 5%. So what was an absolute bloodbath, markets have somewhat recovered. And I think the key message here is to continue to expect to see volatility over the next little while. But
I hate that term you used. I hate it.
What's that?
Bloodbath. I did a video on our TikTok about the top 5 most sensationalized headlines we've seen in these trade wars. Bloodbath is becoming like the term of art for when the stock market crashes.
It's so clicky.
So some of them were, well, I mean, the most sensationalized was billionaires turn on Donald Trump over economic nuclear war. It's more than a
Bill
bloodbath.
Ackman, yeah.
But what about this one from the Australian? Australian shares hemorrhage 160 billion in minutes in ugly market bloodbath. Hemorrhage, ugly blood. It's just so emotive.
Yeah.
It's at its bottom, the market was down 20% in the US.
Yeah.
That happens once every 4 years.
Yeah.
I'm not jumping in a bloodbath once every 4 years. Like at some point, you just have to say that's a normal part of a long-term market cycle.
They're never going to do that. They're never going to do that. As if you would expect to see on a day that you see a 10% drop, that the media is going to come out and be like, this is a normal day in a 4-year cycle.
I know, but that's what causes all the...
What's missing in those headlines is the response being like, look where markets are now, you know...
Okay, what about this from news.com.au? This encourages all the worst investing behavior.
Yeah, sell now.
Worst still to come following ASX bloodbath.
Yeah, that's bad.
Yeah.
Yeah.
It's like, I get it. The whole news industry relies on clicks. We rely on clicks. We play the same game that everyone plays, but it is just encouraging people to make bad long-term investing decisions.
Yeah.
And as we say, the market crash is always front page news. The recovery is on the business pages. I think that's the important thing to remind ourselves as we go through this. It's uncertain, it's scary, but looking back in hindsight, these moments have been the opportunities that you wish you had bought in.
You're right, Ren. Staying on big tech, we've just spoken about Apple. Let's move to Meta. It's their big day in court because the American government's antitrust trial is kicking off. The Federal Trade Commission, or the FTC, accuses Meta of illegally reinforcing its monopoly by buying Instagram in 2012 and then going on to buy WhatsApp in 2014. And they are seeking an order to break up the company.
Now, Meta, in response, claims that it doesn't have a monopoly, and it points to fierce competition with TikTok, with Snapchat, with YouTube, which I think is a pretty fair argument.
Yeah, me too.
I don't know. I have a problem with the idea that 10 years after these acquisitions have been approved, it's like they go through
in hindsight. Oh, whoops.
a M&A process at the time and regulators sign off on it.
Exactly.
But look, anyway, that'll be one to watch. I also think it'll be very interesting to see if the FTC do win and Meta gets broken up. Sometimes when companies are broken up, they actually do better as standalone units, and shareholders would get shares in all 3 of them.
Won't happen.
You don't reckon?
No.
Fair enough. All right, well, let's move on.
The Australian election is fast approaching, and we can sum it up in 2 words. Housing pump. What do you reckon, Ren?
I reckon that is pretty on point. So let's unpack what has been announced so far, because this is fast becoming the who can inflate house prices faster election. So let's start with the party in government, the Labor Party. What have they announced?
So they have unveiled a housing policy that is headlined by $10 billion to build 100,000 new homes only available to first home buyers, and a plan that allows first home buyers to buy any home with a 5% deposit and removing the need to pay for lenders' mortgage insurance.
So that's the Labor Party. And then on the other side of the ledger, we have the Coalition. What have they announced?
So that this I cannot...
No, just tell us what policy is.
They have a plan to make mortgage repayments for first home buyers tax deductible. Yes, you heard us right. This policy would only apply to the first $650,000 of the mortgage and only be available for newly built homes, but still a tax deduction on mortgage repayments.
Mortgage interest repayments.
Mortgage interest repayments. And this sits alongside their $50,000 superannuation withdrawal policy. Wow.
Where you can, for people who are unfamiliar, they can take $50,000, first home buyers can take $50,000 out of their super and use it towards their deposit.
Yes.
So John Keogh, the AFR economics editor, summed up, I would think it's fair to say both of our feelings on these policies. This is how he started his article over the weekend. The extraordinarily dumb demand-side housing policies by Labor and the Coalition will fuel even higher prices and cause first home buyers to take on even more risky debt levels.
Yeah.
He went on to say, Prime Minister Anthony Albanese and Opposition Leader Peter Dutton are offering sugar hits to con aspiring first home buyers into believing that both major parties are making housing more affordable. The cruel reality is both sides are pumping up demand for housing and increasing the size of loans. This will ultimately benefit sellers, property developers, and banks.
Very true.
What do you reckon about that?
I think it's bang on.
So here's my point around housing affordability. There is only one way to make houses more affordable, and that is to bring prices down.
Yeah.
Nothing else is a housing affordability policy. That policies that help some people borrow more or pay more for houses is like, it arguably makes housing more accessible for some people, but it's not more affordable. Like they're going into bigger and bigger debt, or they're drawing on their superannuation and hurting themselves later in life, or they're just getting taxpayers to subsidize their housing because they're hurting the budget and not paying tax. Like none of this is affordability.
No.
This is just the last vestiges of a housing pump desperately scrambling for more money to keep prices rising.
Yeah.
Because the sad reality is, so in Australia, it's basically a third. A third of people own their homes outright with no mortgage. A third of people have mortgages, and then a third of people are renters. And so anything you do to actually drive affordability, to actually bring prices down, will lose votes from two-thirds of the population.
Yeah.
The electoral maths just does not work. And so that's why they're doing all these roundabout policies to avoid the real fix, which is on one hand, truly drive supply, but it takes a while to build. Like I think one of the really unfair arguments around Labor's Housing Future Fund, for all of its problems, is the whole idea that no one's living in a house yet. It's like they only passed it a year ago or something. Like you got to build the things. But anyway, so that is the supply problem. It takes time to build. Claire O'Neill's 100,000 new homes, it's going to take years to build.
Yeah.
So the only short-term solution is to actually take demand out of the market. And the only way to do that is to make it less attractive for investors or to reduce the amount of house that investors can buy, take things like negative gearing off the table. But they're obviously not going to do that.
No way.
And so all of these policies add more demand to a supply-constrained market.
Yeah. It's wild.
They're not housing affordability policies.
I would vote for a policy that dropped house prices.
Well, then you're going to vote for the Greens. It is a sad reflection on where we are when they are the most sober analysts of housing. And then the question becomes around the impact of immigration on house prices in the short term.
Yeah.
And people will, the Greens then have a argument there that's different to the major parties on that impact. But yeah, the reality is the housing pump is continuing.
Yeah, I'd be interested because all of these policies are usually like the caveat, it's newly built homes. And so I'd love to see the data of the third that are, or the portion of new home buyers looking to buy, actually how many of them are looking at new homes. Because it's quite and I'm not trying to say that this has an impact or not. It's just I just think about everyone that I know wanting to buy at the moment. They're not looking for new homes. So a lot of this is, as you said, sugar hit headline stuff that is going to have an impact on house prices. But
it'll also impact on the margins though, because even if you're the people that you're living in inner city and inner Sydney and there's not a lot of new homes there, but it's like as more demand gets brought on for new homes, then that offsets some of the existing demand for new homes, and then that forces people like up the price curve to try and get something else, which is why it's just a supply and demand thing in total. And so like any incremental marginal demand that isn't met by any incremental marginal supply will have a impact of increasing prices.
Yeah, it's wild. Anyway, big election.
The housing pump.
Big election coming up. The housing pump. That's it. We're going to take a very quick break, but as a reminder, if you want to keep up with all of the news, as we spoke about at the top of the show, make sure you subscribe to our daily newsletter, where we'll send you a summary of all of the important headlines from around the world straight to your inbox at 6 a.m. And there's also a podcast where those headlines are turned into an audio format for you to listen to in less than 5 minutes. It's called Headlines by Equity Mates. We're going to take a quick break and we'll be right back. Markets are all over the place at the moment, which means our watch list is certainly getting a good workout. And Ren, we're about to go through some of the stocks that we're looking at.
Yeah, let's get into it. So there's a number of stocks that I guess are reasonably big names, or names that we've spoken about for a while, that have fallen.
Yeah,
the question is, have they fallen into our portfolios? Why don't you start? Because you've got a few here.
I've got a few. None of which have fallen into my portfolios because but I'm now at the point where I'm happy with. I've put money into the stocks that have been in my portfolio that I've wanted to put more money into.
Okay.
And so now it's like, all right, what else is available?
Yeah.
And these stocks aren't just a direct correlation to what's gone on in markets, but it's obviously a point at which that they've fallen further, I should say. Nike, we've spoken about it on the show. It's down significantly, but it's kind of like, is the long-term play here? Nike, I don't think is going anywhere. So I think there's a really good opportunity there. And LVMH.
So for context, Nike is down 69% from its its recent highs in
really
November
bottoming out. Yeah. It's getting pumped. New CEO. I mean, we've spoken about the story. It's got a real turnaround ahead of it. But you just think about moats and like the brand moat that it has here. You look at Rory, who's just won the Masters.
Yeah, I saw he was covered in Nike.
Covered. And it's just like, this brand isn't going anywhere. And so long term, it's like this has been wiped 60%. I think there's a compelling case here. Similarly, LVMH, I saw a stat around the acceleration in the number of billionaires year on year. And it's just like, and the impact that has on all of these luxury goods.
Yeah.
And I think, again, the moat that a lot of the brands within that have, it's like, we're seeing it significantly down as well.
Do you worry about the Chinese factories revealing the luxury secrets?
I was thinking about that earlier on, and all these billionaires going direct to Chinese manufacturers. But no, I don't think so.
The thing for both Nike and LVMH is they will be some of the most affected stocks by a US-China trade war.
Yeah, which it's obviously playing out. And I think we said in our last episode, you've got to be really conscious of that, which is why I haven't put any in, but they're on my watch list. And one that is just, I guess, down because of the markets, but is a long-term compounder, and we've spoken about it, tough to buy, given it's listed in Canada, it's Constellation Software.
Yeah,
I think
love
down
that.
about 12 or 15% from its high. So
but up more than 200% in the last 5 years.
Exactly.
Yeah. Not a lot of brokers give access to Canada. CMC does, but they obviously offset the good with the bad in giving access to CFDs.
Yes.
But yeah, Constellation Software up almost 25,000% since 2006.
Wild story.
Yeah, just
incredible.
For people who are unfamiliar, it just buys niche software companies run by this guy called Mark Leonard, and it has just been incredible. Yeah.
So those, I guess, mainly two that I think are really down and out at the moment, which I'll keep an eye on. What about you?
So I've bought some stuff. I spoke about this on a previous episode. Bought some more Google. For the first time, bought Eli Lilly. Bought some Macquarie when it fell. And I'm watching a few other things. But on the Eli Lilly story, I'm not sure if you saw the Pfizer news this week.
No.
So for a long time, there's been this theory with GLP-1 drugs, the Ozempic drugs, that they're gonna become commoditized. Mm-hmm. That like more and more people are gonna be able to make them. They're not actually that complex to make. Mm-hmm. Well, that theory was challenged this week because Pfizer has always been seen as the 800-pound gorilla who's going to try and enter this industry. Their drug has been discontinued because in trials a patient suffered a liver injury, and so it's kind of challenged the idea that these big guys are going to enter the space and compete on price and drive price down. So
love that.
It's just a reminder of I don't love what happened, but
obviously,
yeah, for the Eli Lilly of it all and the Novo Nordisk of it all, I own both of them. Full disclosure. It's just an interesting one to keep in mind. Eli Lilly's still expensive, still trading at like 60 times last year's earnings.
Huge opportunity.
But speaking of Australian medical, not Australia, but speaking of the medical industry, how's this for a analyst note on a small Australian medical device maker?
Okay.
Quote, could be the next Cochlear or ResMed.
Huge call.
That was written about EBR Systems.
What do they do?
They just got FDA approval in the US to sell their wireless heart pacing system. Not a huge addressable market, about 39,000 people in America, they think. But essentially, it's like a grain of rice sized device that gets inserted into the patient's heart or near their heart, and it like keeps it from failing.
It's a pacer.
I guess so, yeah. Yeah, but it's apparently just incredible.
That's nuts.
Yeah.
Grain of rice.
But as soon as you're getting compared to Cochlear or ResMed, you've either got an investment analyst who's competing hard to win business for their next capital raising, or you've got a pretty exciting company on your hands.
Wow.
Yeah.
EBR Systems.
A reminder though, the day that they got FDA approval, a reminder of how volatile biotech is, especially small biotech.
Yeah.
The day they got approval, shares fell 17%. Because they'd been
not good enough.
They'd been rising for a long time, and a lot of early investors they think cashed out.
Gotcha. Yeah, makes sense.
Yeah, wild ride.
Well, so those are on our watch list, but we wanted to, we took the opportunity to run a bit of a scan or a screener through one of the platforms we use, Guru Focus, to look at some Aussie stocks, or to try and find a list of Aussie stocks that matched a bit of a criteria. Now, we should say that we have a link to Guru Focus in the show notes where you can sign up and get access. Super comprehensive stock screener, global. We quite like it.
So here's the criteria we plugged in. Above $1 billion market cap, profitable, revenue growing at more than 10% a year over the past 5 years. And then some valuation metrics. We said price to earnings of less than 20 and price earnings growth ratio of less than 1.
Yep.
The idea of finding companies that have fallen, that are profitable and growing their revenue, but are starting to look cheap. So looking at this criteria, there were 6 companies in Australia that met it. Some pretty well-known names. Fortescue.
Yep.
Block.
Nice.
Yeah. And then Antam, which is the major Indonesian nickel miner, but listed in Australia.
Love it.
Stanmore Resources, the coal miner, NRW Holdings, and then one New Zealand company, Somerset Group Holdings.
Retirement villages.
Yeah. So, I mean, to dig into some of the numbers there, like if we rank them by their revenue growth rate, how's this for a story? Stanmore Resources, past 5 years, growing revenue at an average of 35% a year.
Okay.
Profitable.
Yeah.
Trading at a 5 times PE.
Okay.
10% dividend yield.
Wow. No wonder everyone's off ESG.
To be fair, could be a bit of a dividend trap.
Yeah.
The stock's down about 60% in the past, call it 18 months.
Okay. What about Block? Tell me about Block.
So Block is formerly known as Square.
Yes.
It owns Afterpay.
Yes.
Ticket XYZ.
Yes.
What else do you want to know?
I want to know its numbers.
So it's grown revenue at about 27% a year on average for the past 5 years. I think fluctuates between being profitable and not profitable. But yeah, it's down like 80%.
It's also down, yeah.
Down 80% from its highs in 2021.
Yes, yeah. Big time.
When
it did the monster deal with
Afterpay. Yeah. The well-timed acquisition. So just to close it out, I want to so there was 6 in Australia that met that criteria, but I just did the same in the US just to see like what companies popped up. A number of oil companies popped up, I think, because the oil price has fallen so much. So a lot of them have sold off. Exxon, Chevron, Total Energies, ConocoPhillips all popped up, or Petrobras in Brazil also. But some of the other names that popped up: Alphabet, Toyota, Caterpillar, Chubb. I think Deere was on this screen. It just fell off the screen as we lowered the price to earnings. So some like pretty established long-term compounders, I would say, like those industrials, Deere and Caterpillar, those that will just keep grinding, are starting to become
more attractive,
become quite interesting. But I thought it was quite interesting to see Alphabet there. Let's close it out with their numbers.
What's their PE now? 18?
Like 19 point something. So just snuck under. But it's profitable. Its net profit margin almost 30%, 29%. The last 5 years, it's grown revenue at an average of 19.9% a year.
Love that.
So sometimes the most obvious answers are staring right in front of you.
Yeah, it's kind of like, are we missing something? That's what I keep thinking to myself. It's like,
I mean,
it's AI. It's got to be AI.
No, it's also that in an economic downturn, the first budget line to be cut, advertising.
Yeah.
And so Meta and Alphabet, their users are going to be fine. Like the users will still be there. They're free to use products. Yeah. But in terms of their revenue, it's advertising.
But is that like, that's not the commentary coming through at the moment?
I think that's
everyone's like cutting advertising budgets and stuff.
But I think a lot of people are nervous. There was a survey out of the US that 2/3 of American CEOs surveyed think they're going to see a recession in the next 6 months.
Wow.
So it's like people will start making adjustments. Whether or not it happens, if they think it will happen, they'll start making adjustments.
Yeah. Well, pretty compelling still, I think. But look, as I said, we'll put a link in the show notes if you want to check out Guru Focus. Very comprehensive stock screener. But always great to chat stocks. If you have taken value from what we've spoken about today or any of the other episodes that you've listened to, firstly, if you could share it with a friend, that would be really appreciated. But secondly, if you could rate and review our podcast in your podcast app or leave a comment in the YouTube section if you're watching us on YouTube, like the video, subscribe to the channels. We would really appreciate that. We love hearing your feedback, good or bad. We read them all. We cry when we go to bed if they're not great, and we rejoice when they are. But yes, we really love hearing from you guys. But Ren, we'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.